If I may now introduce you to one of our great member companies, H.W. Fisher. H.W. Fisher are expert in accountancy, audit, tax, corporate and financial advisory services. We work with them closely. They have expertise in all sorts of areas, helping companies and individuals looking to set up in the UK. We have three of their specialist speakers today. We have got Toby Ryland, we have Bonell and Gerry Myton, who will speak to you across a few different areas about the corporate structuring, global mobility, and also VAT and duty, and also R&D credits and the like. So covering a fair bit of content here, but you'll see there's a lot to be considered, and this will give you a great introduction to some of those important topics. So on that particular note, I will hand over to Toby.
Thank you very much, Richard, and nice to meet everybody virtually. So, as Richard very kindly introduced us, we are a firm of chartered accountants and tax advisors based in central London. We have a lot of experience dealing with inward investors into the UK from all around the world. But obviously we have quite a focus on Australia and helping Australian businesses set up in the UK and prosper here. So what we will be doing is running you through corporate structuring and corporate tax issues at a fairly high level. Then we'll be running through global mobility, which is largely moving employees cross-border. And then I'll be passing over to Gerry Myton, who will run through VAT, our equivalent of GST, and customs duties. So let's kick off with corporate structuring, inward investment into the UK. I think as Stephen quite comprehensively outlined, the UK is a very business-friendly jurisdiction. The government is saying that growth and economic growth is their absolute key priority for the course of the next Parliament. And the UK has historically had a very keen focus on attracting inward investment into the UK. So this is a continuation of a long-standing policy. I should also make the point that the UK is not just London. There are many opportunities throughout the UK. There are lots of regional incentives available to attract businesses to different parts of the UK. So whilst London is often seen as the key focus, there are opportunities throughout the country. The sort of financial incentives available range from things such as reduced business rates, reduced stamp duty, increased tax depreciation allowances, through to the simplification of planning permission if you need to build premises, factories, industrial buildings and similar. And there are also various grants available to businesses investing in the UK. So it's definitely something worth looking at, not just focusing on London, but looking at the UK as a whole. The other big benefit of the UK is that we've got a very stable tax and legal system. It's straightforward to open here, it's straightforward to do business here, and the whole system is designed to make it as business friendly as possible. On top of this, we also have a very wide tax treaty network, probably the widest of all countries globally. So it's generally easy to operate from the UK and work with different territories, whether that's just in terms of repatriating profits, financing businesses either into the UK or from the UK and more widely. We've got a very, very good tax-friendly treaty network. And as Stephen referred to a few minutes ago, we've got a good competitive low corporation tax rate compared to most of our EU competitors and more widely. So moving on now to how do you actually set up in the UK? There are broadly two main options. So either having a branch, which is just an extension of your Australian existing company, so you would just start to operate here, but it would be the Australian company actually operating in the UK, or you would set up a UK limited liability company as a subsidiary of your Australian parent. The tax difference between a branch and a subsidiary is fairly immaterial. They're both broadly taxed in the same way. But there are some quite stark differences in terms of how they have to report and also how they're perceived. So a branch is very straightforward. There is no separate entity. It's just simply a business registration here. So it's quite simple, but there are disclosure requirements. So if you had a branch of an Australian company, then the Australian company would have to register that branch and be visible on our company's house here. And it would also be required to file the Australian company's financial statements at company's house here in the UK, which are open to public inspection. And so details of ownership and things like that will become publicly available here. Now, in terms of Australia, that may not be too much of a concern due to your disclosure requirements in Australia, but for a lot of other territories, this is quite a significant drawback. The other point is that a branch is not a separate entity from a legal perspective. So if the branch is subject to litigation, it's actually not the branch itself, but it's the Australian company that would be at risk. So that's why a lot of businesses prefer to have a UK subsidiary, a separate limited company. If you do that and you set up a UK limited company as a subsidiary, the subsidiary prepares financial statements and publishes them, but there's no reference to the parent company. And also, if there's any legal risk, it would be the subsidiary company itself which is at risk and not the Australian parent. So for those reasons, we usually find that the preference is to incorporate a UK limited liability company to operate in the UK. And then beyond that, there is perception. Rightly or wrongly, it's seen that a branch has less substance and can be closed down and disappear much more easily than a limited liability UK company. So just from dealing with the public, dealing with other businesses, there's often a feeling that a subsidiary is a better option than a branch. So then moving on to what are the tax rates? The UK, as we say, is quite competitive. The main tax rate is 25%, which is lower than the other G7 nations. And it's a fairly static rate. There is a small lower rate for very, very small companies, but you can broadly plan that you will be paying 25% corporation tax on profits realised here in the UK. The other main cost to businesses operating here is our social security, known as national insurance contributions. This is currently 13.8%, but is increasing to 15% in April. The government will hopefully not be doing anything beyond that increase. And that's paid, it's the employer's contribution paid on the wages that are paid to employees here in the UK. Our corporation tax is payable typically on a quarterly basis. So you pay 25% of your liability each quarter, totaling 100% over the course of a 12-month period. This does apply for large companies where profits are over £1.5 million sterling, but those limits are reduced by the number of companies worldwide. So if you had an Australian parent with a UK subsidiary, the limit drops to 750,000. So a lot of companies will be paying in instalments. for those companies that drop below those limits, they would pay their tax 9 months after their year end. So it's relatively straightforward in terms of tax payment dates, and it's just a matter of monitoring them. The big advantages of the UK and the tax system, which Stephen referred to these very briefly, is we have no withholding tax on dividends. So if you have a UK subsidiary wants to repatriate its profits and pay a dividend to its Australian parent company, there's zero withholding tax on those dividends. We do have some withholding taxes on interest and royalties, but under the double tax treaty with Australia, these are reduced to 10% and 5% respectively. And then we do have some nice tax reliefs. So we've got R&D tax relief. There's now one main scheme. It's been simplified quite significantly, with an enhanced R&D scheme for new startups which are loss making. But very broadly, what this does is give up to 27% of your R&D expenditure back to the company. So effectively, the UK funds over a quarter of your R&D spend. There is quite a lot of focus in the UK now by the tax authorities to make sure that the scheme is being operated and owned correctly, and that only genuine R&D is able to obtain the relief. But it's something that's very beneficial, and we can help you through that process. Compliance obligations are fairly straightforward. You file financial statements once a year. You file a corporation tax return once a year. Payroll is operated usually on a monthly basis. If you offer share incentives like share options or other sort of equity incentives to any employees, there is an annual return just reporting that to the tax authorities. There will be VAT returns to file, usually on a quarterly basis, can be more regular in certain circumstances, and there will be a Companies House annual return to file. Excuse me, so these are fairly straightforward, probably not dissimilar to what you're used to in Australia. And the key thing is just to plan for these, which we can help with, keeping a record of when your accounts, when your tax returns, when your other filings are due, to make sure that no penalties for late filing are incurred. But we can help with that process and make sure that everything runs as smoothly as possible and take some of the stress away from opening a business in a foreign current country. So it's a very brief overview. There's obviously a lot more detail, but hopefully it gives you a feel for what it's like on the corporate side to operate and trade in the UK. And so now I will pass over to my colleague Adam Bonell, who will talk through the global mobility and employment tax considerations.
Okay, thank you, Toby. Good evening, good afternoon, good morning. So my name's Adam Bonell. No connection to Australia's biggest family, but I am a tax partner here at HW Fisher, and I work with Toby and Gerry to essentially bring businesses into the UK. And my particular focus is looking after the employees and their families, and looking at the employment taxes and the income taxes that arise out of this. So on that note, I just wanted to talk about some employee issues today. So the key employees, I've broken them down into 4 categories here, you can see on the screen, and I just wanted to run through each of these in turn and just highlight some of the issues that we typically see during different stages of the business transitioning to the UK. So if I could have the first slide, please, Toby. So short-term business visitors, and this is essentially, I suppose, quite often what you see. You've got an Australian business, they may send employees to the UK from the Australian entity just to sort of test the water, see what markets are available. And technically, if you have an individual who works in the UK for a single day, their earnings in relation to that day's duties are taxable here. Now, obviously, that creates tax burdens, huge complications in reporting, filing paperwork, etc. So there are a couple of quite important exceptions to this rule. So the first is where the individual is not resident. So residency in the UK is principally determined by the number of days that somebody spends in the UK in any given tax year. So our tax year runs to the 5th of April. And very broadly, if you're here for less than 45 days, you're not resident. If you're here for more than 183, you are. And between those extremes, it depends on your ties to the UK. But as a rule of thumb, if you're here for 90 or 120 days, you're probably not resident if you don't have sufficient ties to the UK. But as I said, it's governed by a statutory law. So it's one of the things we can look at with employees and say, look, provided you keep within these parameters, you're a non-resident. And the importance of being a non-resident means that if you're in the UK and you're here doing incidental duties, then those duties are not taxed. So UK authorities will say, we'll not tax you. And an example of an incidental duty might be you're here on a conference or you're sort of meeting customers. So that generally wouldn't be taxable under UK law. Another really important exception from the standard UK rule is afforded by the double tax treaty. Now, as Toby mentioned earlier, we have a significant network of double tax treaties, and the UK-Australia one is a very comprehensive example of one. Now, within that, there's what they call an employment article, and I put the summary on the slide there, but in essence, what it says is where you have an Australian employer, if you send an employee to the UK for less than 183 days, then provided the cost stays with the Australian entity, then that individual isn't subject to UK taxes on the duties they're performing here. Now, obviously, that's great for the individual, but it's also very good for the company because it means you don't have to consider taxes, social security, and payroll filing requirements. So you quite often see this in the early stages of a business sort of putting their foot in the water in the UK. If I could have the next slide, please, Toby. So local hires is, again, another sort of early stage, which we see where you've got an Australian entity that maybe wants somebody on the ground. Maybe they're not quite at the stage where they can get the visas arranged. So they employ somebody locally. Now, with a local employee, they will be subject to tax, regardless of where they do their work. They're subject to taxes in the UK. And that generally requires a payroll to be operated. So as an employer, you'd have to withhold taxes on a monthly basis and social security and pay that over to HMRC. There is a quite an interesting quirk in the system where employers who do not have a place of business in the UK can't be forced to run a payroll. So if you're an Australian entity with only a single employee in the UK and that employee does not create a place of business, then you don't have an obligation to operate a payroll, and simply they must operate their own payroll. So they must report information to HMRC themselves. Now, the significant benefit to this, as well as saving you a lot of administration, is you don't have an employer's national insurance liability. Now, as Toby mentioned earlier, that's potentially 15% of the salary being paid to the local hire employee. So you will save that liability by not having a place of business here. There's one catch: you cannot have a place of business within the EEA, because if you do, they can collect that money from the EEA and it sort of reinstates that liability. So again, something that comes up quite a lot, saves a significant amount of money in these sort of early startup period. So worth considering. If I could have the next slide, please, Toby. So permanent long-term transfers, I've got this slide in. It's similar sort of concept to the previous one, except you've probably got enough establishment here in the UK now to have to operate that payroll. There are certain incentives for a foreign national coming to the UK, and the rules have changed quite significantly over the last few months. And many of this is actually subject to a presentation I did to the Chamber of Commerce back in November, which I think is available to watch online. But in essence, if you're an foreign national or you've been living outside the UK for at least 10 years, when you come to the UK for the first 4 years that you are here, you can apportion your earnings between UK and non-UK duties. And the non-UK duties are, in essence, where you're physically located overseas. So if you've got somebody whose your base is the UK, but perhaps they're traveling around Europe, then any day they're physically working in France is a non-UK duty, and we can exclude that from UK income tax. So for those employees coming here wanting to travel, again, this is a real incentive to reduce their UK tax burden. Generally speaking, they've got to file a tax return to get this relief, but we can sometimes get it in the payroll as well. So again, just something to sort of entice people into the UK, I think. If I could have the next slide, please, Toby. So secondments is perhaps the most interesting area of sending employees to the UK, and certainly the carrot that you need to get people over here potentially. So a secondment is where you have somebody working for the overseas entity, and you are saying, we want to transfer you to the UK for a temporary period. Now, a temporary period is considered up to 24 months. So if you send somebody for this amount of time, you can claim they can claim as a tax deduction their general cost of living expenses whilst they're on the assignment. So that includes the rent, utilities, home to work travel, food costs. And as you can imagine, those are quite significant expenses, and potentially they're saving up to 45p for every pound spent on those expenses. So it's really good. The employee saves the money. The other advantage to the employer is on a secondment where you send somebody to the UK for a temporary period. For the first 52 weeks, there is no employer's national insurance. So again, saving that 15% for the employer. Toby, can I have the next slide, please? So tax equalisation and protection, this is essentially, we use this as a tool to take tax out of the equation for the employee. So if you've got somebody, or if you're somebody yourself wants to come to the UK, but you don't want to worry about the tax burden, you can do something called equalisation or protection. And in essence, what this says is, we're going to treat you as if you've never left your home state. We're going to treat you as if you never left Australia. We're going to withhold from your salary what they call a hypothetical tax, and we're going to guarantee you a net payment. And in the UK, we'll gross up your tax and we'll pay it. Now, this can be quite expensive for the employer, so it needs to be looked at quite carefully. But if you've got an employee who qualifies for the secondment reliefs and maybe is travelling, we can really get the UK tax cost down, and those savings will go back to the employer in a tax equalisation scenario. So again, really quite a useful tool when looking at sending employees overseas. You've got to be really careful how you document this, of course, because as you might imagine, when there's refunds, employees sometimes think they belong to them, but really they belong to the company. So, it's all clearly documented, but it's a very useful tool, particularly with larger expat populations. If I could have the next slide, please, Toby. So, as I highlighted earlier, a lot of changes in the UK tax regime and how we treat foreign nationals. One of the exciting things is, and I think this is going to be relevant for a lot of Australians coming here, where you've been non-resident for 10 years. For the first 4 years you're here, your family members are not going to be subject to tax on your foreign income and gains. So what this means is, where we used to have to do quite a lot of pre-arrival planning before people come to the UK, now you get that opportunity to do a lot of that planning in the first 4 years. So if you had foreign assets and shares, they can sell them. And that makes it quite easy to get people over here quickly if you need to, because they don't need to do too much before they arrive. There are some changes which might put people off, although we're still waiting for clarifications on the rules. But inheritance tax is something that I know is a big issue for Australians in the UK. The rules are, at the moment, if you're here for more than 10 years, you're potentially within the scope to UK inheritance tax. Usually we're looking at employee populations of less than 10 years. Of course, if we've got anyone who wants to stay longer, there are certain planning opportunities which we can do to mitigate that exposure. But generally speaking, I think the changes are good for employees coming to the UK, and there's plenty of opportunities. The things we do need to watch out for are, as I mentioned in the slide, trusts, which are quite commonly used in Australia, may not be tax efficient in the UK, and in fact can have adverse tax consequences. So they certainly need to be looked at prior to arrival, where you've got employees with trusts. Moving back to the employment, in terms of long-term incentive awards and shares, again, just needs a little bit of care to make sure we understand what those awards are, how they vest, because you can end up with a situation where you've got something granted before somebody arrived in the UK, and maybe it vests after they've left. But because you've got a period of UK employment in between, there could be UK taxes on that. So again, it's just ideally looking at these schemes before somebody comes to the UK, doing that analysis and going into it with your eyes open. There are lots of other sort of interesting points that you can get tax relief on. As an example, if you do second somebody from Australia to the UK and then you turn them into a local hire, this may trigger payments due to them in Australia, capital payments due to the termination of their Australian employment. Generally speaking, we can get those as exempt in the UK, either because it falls in that first 4 years or because we can get it exempt under UK rules. So again, potentially some planning opportunities to look at there. Okay, so that's a sort of very brief overview. I'll pass you over to Gerry now. Thank you.
Thank you, Adam. Obviously, I work with closely with both Toby and Adam, advising inward businesses coming into the UK to trade, and also those businesses from Australia who are moving into the EU. My specialism is VAT and duty, having specialised in this since the 5th of February 1990. So year 35 is just around the corner. Currently advise businesses from Australia who are in financial services, businesses that are selling goods that are not origin Australia, and also Australian businesses in the wine and spirits sector. So Toby, could I have the first slide, please? Okay, we're going to talk today about a number of things around VAT and duty, looking at goods and services, VAT registration. First point is always VAT registration. When do you need to register and why? Always split that down into two particular areas. Those that are established, and as Toby's talked earlier about branches or subsidiaries, basically a branch or a subsidiary will have a £90,000 turnover limit to VAT register in the UK, and there is two tests in meeting that 90,000. The first test is a rolling 12-month test, which looks at your turnover for the last 12 months. So if you were to exceed the £90,000 turnover test today, the 30th of January, you must register within 30 days. So you must notify your requirement to be registered by the 28th of February, and your registration date will become the 1st of March. Now, the second test is a realisation test. If you realise your turnover is going to exceed £90,000 in the next 30 days, the registration date is the date you become aware. So on 1st of January 25, you arrange a £95,000 contract. You must submit your registration application by the 31st of January, and a registration date will become the 1st of January. Now, VAT is one of these taxes which attracts a lot of penalties. You are in the UK, you are an unpaid tax collector, and you get penalised severely if you get it wrong. So on registrations, HMRC have a failure to notify penalty. If you fail to notify by the correct date, they will assess you for a penalty based on the potential lost revenue. And that penalty is usually set around 30%, but is usually levied at 15%. So be careful on VAT registration dates. You're also entitled to register on a voluntary basis if you're below the threshold, the £90,000 threshold, or you can also register as an intending trader. You're basically developing a business concept, you're incurring cost on the ground. HMRC will try to resist that, but we always go back and quote at them established case law, Merseyside Cablevision being a UK case and Rumpelmann being a European court case. If that business fails, then we're into basically it's abortive, and again, we point at law and say you can retain VAT recovery because of the European Court in Ghent Coal BV. Now, you might say the UK has left the European Union. Correct, but basically a lot of the Withdrawal Act, basically all these concepts in previous cases have effectively come into UK law. HMRC are still quoting those cases at us. We're entitled to quote them back. Now, if you're not established in the EU or the UK, you have a registration threshold of 0. So if you do anything, you're liable to be registered. So it comes down to a case of basically, what's your business look like? Do you have boots on the ground, etc., in the UK that require you to be established? You have the human and technical resources to consume supplies. We'll say that you have certainly a fixed establishment for VAT purposes and therefore are established and the 90,000 applies. So watch that aspect carefully. Determine what your position are, what your status is. And a lot of people get accidentally caught by the non-established point. I'll come back to that a little bit later. Toby, can I have the next one, please? Now, we're going to start with goods over the next couple of slides, then move on to services. We're looking at physical items arriving in the UK. Incoterms is the big driver here. In total, there are 11 Incoterms with 12 obligations within them. These range from Ex Works through to delivered duty paid. Now, generally what I say around Incoterms is effectively depends who needs who most. So if you're really desperate to sell to that UK customer, you'll probably end up under DDP, where you are responsible for everything from the packaging to delivery to import VAT to customs clearance to duty, etc. The other 10 that are non-DDP, from Ex Works through to delivered at place, various bits are done by the seller, various bits by the buyer, but the important bit in all of those ones, it is the buyer who is the importer of record and has the legal obligation to import the goods into the UK and pay the duty and VAT. So could I have the next slide, please, Toby? Now we slightly move on a little bit and sort of make things slightly more complicated. Origin of goods will drive duty. Now, as David said earlier, that the free trade agreement between the UK and Australia will eliminate tariff on the majority of items across a number of years. But where you're buying goods, an Australian business is buying goods that is country of origin China or another, say, Southeast Asia country, you still have the issue of duty on arrival of the UK if the tariff dictates that it has a positive rate of duty. Now, there is, after the UK's decision to leave the European Union, there is a potential double duty trap. And what we look for clients is basically looking at supply chains, looking at markets, and trying to negate that double duty trap. Because if you have goods with a positive rate of duty that are landed in the United Kingdom, and then a proportion of those goods are then sent to the European Union, technically, you will have duty payable in the UK on 100% of the goods arriving, and you may then pay double duty on 40, for example, 40% of the goods that head into the European Union. Now, what we do there is we look at basically authorizations under customs procedures. Particularly in this case, we'd be looking at something like inward processing and particularly Economic Code 21, which basically what Economic Code 21 allows you to do is effectively to unpack, repack and send back out again, and only those items that remain in the UK are subject to UK duty, and the items that go to the European Union are subject to duty in the EU. Now, there is a second problem out there for a lot of businesses. I've just finished work with one Israeli business and one Australian business who fell into a particular duty trap. They were basically having goods manufactured in China, and then those goods were being sent to the UK. Now, what HMRC are currently undertaking a significant campaign in this area. This resulted from the UK being fined by the European Union £2 billion post the UK leaving the EU, but relating to issues whilst we were still a member around the policing of imports from China. HMRC are now looking closely at all imports from China, both on a classification and evaluation matter. And what the theme running through all this is that the Chinese supplier is offering to arrange the import into the UK on behalf of, say, the Israeli or the Australian customer. They appoint their own customs agent. Those customs agent basically accepts the numbers provided by the Chinese supplier, manufacturer. So that would be the classification or tariff code and the basic the values of the goods, etc. Now, what is happening on the ground is HMRC, who are certainly more active these days in customs duty than they are on VAT, are undertaking post-clearance inspections. Now, sometimes those are just administrative. It's your turn to be reviewed, or other times it relates to a shipment that has been stopped. HMRC have opened it, inspected it, and basically said, well, we want a deposit because we don't believe the duty and VAT is correct. And they follow up on that deposit where there has been no attempt to recover the deposit paid usually by the customs agent. So it ends up with being an awful lot of work for you, the importer, to basically amend all the entries, work with HMRC, be potentially penalised by HMRC for failing to declare the correct value at import, and fees for professional advisors at times outweigh the actual real cost to you. So what I'd say to anybody importing goods to the UK, please appoint your own UK import agent to ensure that the correct classification and valuation is applied to goods, because the admin hassle down the line well outweighs any perceived benefit. And while we're talking about goods, I mean, most of what I've been talking over the last couple of slides have been about business to business transactions. Business to consumer. Changes since we left the European Union. We're looking now at where you sell B2C, if you're selling goods to a private individual in the UK, and that consignment value is below £135, you can basically register, import the goods, no customs check, they just simply fly through the system, delivered to the customer, no hassle, etc. Above 135, generally you have to become the importer of record and basically pay VAT and duty, and then basically charge VAT to the customer. What you don't want as a supplier is basically goods coming into the country and the customer getting DHL coming along saying, we need £40 from you to release these goods to you because VAT and duty has not been paid. So watch the supply of goods into the UK, both from a B2B and a B2C aspect, because it can lead to issues, which obviously takes time and cost to business, which eats into profits. Could have the next one, please, Toby? Sorry, Toby, if you just stop and flick back one moment. Sorry, I missed something at the end. Just one point on the end of postponed import VAT accounting. When you bring goods into the UK, you can use PIVA. What PIVA means is you do not pay VAT at the point of import, and you basically make a plus and minus entry on your VAT return, and basically it saves you cash flow. So rather than basically pay the VAT and say 30th of January, your VAT returns are January, February, March, you won't get the benefit of that to 7th of May. Not paying it and using PIVA means you get instant cash flow advantage. Kind of the next one then, Toby, please. Services is generally, we'll do B2B very, very quickly. Basically, most of those services reverse charge. Very little VAT obligations in the UK around services. There might be some around live performances, land-related services, hire of means of transport, which can trigger VAT registration. The point I'd always make about services is check before you do it to make sure it's right. If you're established in the UK and you're buying in services from overseas, that will count to the UK VAT registration threshold. One other point is you can have sales staff in the UK, representative office, recovering all the costs of finding customers, then basically charging those off to the Australian parent at, say, cost plus 5%, full VAT recovery. And then finally, slide 5, Toby. The real complex area is services and B2C. Can trigger VAT registrations because there's basically issues around electronically supplied services. Those are items that are delivered over the internet or via an electronic network with minimal or no human intervention. What I'd say is where the situation is something like a customer clicks the buy now button on a website or downloads something, you're probably caught. It means a registration in the UK, probably means a registration in the European Union as well, and in many other jurisdictions. I've had one client who's recently had a request from Kazakhstan for them to VAT register for electronically supplied services. So it's things like online magazines, supplies of software, downloading of films or music, etc. If you're in that area, be very careful. And just one final point on VAT. Toby said earlier that you're talking about corporation tax 25% of profit. VAT isn't 25% of profit. In the UK, it's 20% of turnover, which can lead to a very big number and significant penalties. You know, you're an unpaid tax collector, you get it wrong, you get penalized. So getting it right and getting it right early would be my best advice to anyone looking to trade into the UK. And at that point, back to Richard.
Thanks very much, gents from HW Fisher. That was incredibly thorough. Again, I think, you know, in each of your presentations, there was that strong recommendation is do your homework early, plan early, don't dive in. It's the right advice. Thank you again for the three speakers.